4.5 years ago, a member of the biz news community said they were sick to death of the debate that was always going on about local versus offshore. And so they wanted to put it to the test. Well, they couldn't have chosen a worse time if you were batting for the offshore side, because November 2021 was just about the peak of the global markets, the global tech markets, and into that difficult situation walked Magnus Heystek. And as a consequence of that, though, you've got to give him some credit. The portfolio took an awful hiding. He's been very transparent and has conversed with us throughout this series and saying, mea culpa, I've learned quite a lot from the process. And anyway, he's in the black. That R500,000 he was given is 629,000 Rand as we sit. But way in front is Piet, who's focused only on the local side. 809,000 Rand from the 500,000 Rand, and we've got 6 months to go. So in the absence of a catastrophe locally, it looks like Piet is home and hosed. But we'll find out what the two gents themselves think about it. Good to see you. I'm glad you guys are you're pals and you get on and you're not at each other's throats, because this has a possibility of turning very nasty. Here you've got Magnus, who probably feels hard done by, given the timing of the competition, and Peter, on the other hand, who probably feels hard done by because everybody says take your money offshore if you've got any chance. There's got to be a lot of learnings, though. You're dealing with real money. You're doing it in the public environment. Magnus, I know you've been transparent, refreshingly so, and saying, well, you panicked a little bit here and then you changed things and that. But if you were to give us the one big learning that you got so far with 6 months to go out of this competition, that you can pass on to the millions of Biz News Tribe members, what would it be?
Well, first of all, hi, good morning, Alec, and good morning, Piet. I hope you guys are well. Investing is how you deal with risks, and the risks are unpredictable. When we started the investment, if you go back 10 years up to that point, it was a no-brainer where you should have put your money, and that was offshore. And the investment markets can sometimes teach you a lesson, and you've said already that at that point, the rand suddenly strengthened and the offshore markets took a hell of a dive. And you've got to, it was not a great time to start this competition. The second mistake I also made is I became very emotional and I made some amateur mistakes. I tried to time the market. So the market timing is a very big issue, and a lot of investors, retail investors, try and time the market, and I'm sure Pete gets it as well. I get so many emails and phone calls and say, I want to invest money now, but when is the right time? And you simply don't know. And we saw it last year, for instance, beginning of the year, we had the Trump tariffs, and that smacked the dollar price, and the gold price rocketed, commodities rocketed. And last year was a phenomenal year for the JSE. So you couldn't predict that. It was not in the charts. It was totally, it just happened. And that's what markets are like. And you've got to stick to your plan. Just one correction, Alec. The current value on the offshore portfolio is 685 this morning. So there's been a very nice recovery in the markets. Believe it or not, April, despite the war in Iran, has been a phenomenal year. There's another lesson. If you look at the headlines going back to February when the war broke out in Iran, every headline was markets are going to crash, take your money out. And we had Jeremy Grantham again saying, oh, markets are going to tumble, take your money out. And we had the best month in 5 years in global markets. So investors need to learn to not be emotional. It's a long-term game. And if once you've established a portfolio, you need to stick with your risk profile and let the markets do what it does. And also that the advisors or the fund managers, they must do their thing. Don't try and be smarter, because there are millions of people out there who are much smarter than you, the average investor. So those are the lessons. So since I sat down, relaxed, created my portfolio, gave some money to Anthony Ginsberg, who runs the Megatech Fund, Sean Pesh, who runs the R1m fund, and I put some money into gold and Japan. The portfolio has done exceptionally well. In fact, from its low, when the fund was at $20,000, it's actually doubled to $40,000. So, just stick to your plan. The markets will look after you.
Isn't that interesting? It's doubled, and that 689, the current level of the portfolio, the community member who put up the R1 million actually gave me the figures on the 5th of May. We're now talking on the 13th of May. So from the 5th to the 13th, Magnus's portfolio has actually put on 10%. So it just, sorry, not quite 10%, but almost, say 8%. From 630 to 689, it is a very big uplift. Just to remind you as well.
The technology stocks. I mean, if you look at the Magnificent Seven and all the technology stocks, I think Anthony Ginsberg's fund is up 16% in 1 month and is up 24% for the year. And that's lifted the portfolio fantastically. The one sort of volatile sector of the portfolio is the allocation to gold shares. And I've left it as it is. Gold shares have been up and down like, I'm not going to use that expression, but it's been up and down quite
like
quite
a yo-yo.
Not,
you can say yo-yo.
Like a yo-yo. So it's been a fantastic learning curve in many respects. I think I'm a better advisor than a fund manager, and give the money to good guys, let them manage the money.
Piet, you have had a stellar performance just based on discipline. Magnus is maybe just a bit of mea culpa here. Many years ago, when we had a radio show, I was asked to play in futures, which I know nothing about and still don't know nothing about. And I quickly lost just about all the money that had been put up by the sponsor. And then Arthur Buchner, who was our advisor, I asked him to come in. He was a futures player. And he actually not only regained all of the money that I lost so quickly, but he added to it. And I think it shows that being on the outside, I don't mean any disrespect to you, Magnus, but you have to look after emotions. You're looking after psychology of your clients. There's a whole lot of other things that come to play. With Piet, hopefully all you look after is the focus on growing money and being an asset manager. I learned that from that little competition that we had on the radio. And man, I think we are seeing this in working right now, that when you've got a plan, as Magnus mentioned, and you stick to it as you have, Piet, even though 4.5 years ago, many people would have given odds against you outperforming, you have, and quite some.
Yeah, look, the reason I was willing to take the bet 4.5 years ago, because at that time, the anti-South African investment voices were very, very strong. There was a lot of negative emotion around the South African investment environment, the country, GDP growth, unemployment, all those sort of things. But my view was that those negative views were more than priced into the market. So it was simply saying that, yes, these things are there, they are bad, but they're priced in and more. And that is exactly how it's panned out over the years. So, and my view is based on the work of three guys, Dimson, Marsh, and Staunton. They do an annual investment yearbook where they look at the returns of different markets in the world. And they went back to 1900. And over the past 125 years, from 1900 to 2025, the best performing market in real currency adjusted terms is the South African equity market. Over the last 25 years, one of the best markets in the world in real currency adjusted terms is the South African stock market. And over the past 5 years or 4.5 years, I think this exercise has also shown that the returns available from this market are high. So Dimson, Marsh and Staunton did one other piece of work as well. They said that there is no correlation between GDP growth and stock market returns for any market. I mean, you can look at China's. China's probably had the highest GDP growth in the world for the past 30 years, yet the investment returns from that market have been disastrous. Conversely, South Africa has had poor economic growth, high unemployment, yet our stock market remains one of the best performing markets in the world. And the reason is very simple. Low GDP growth, high unemployment, and those macro factors and poor political environment weigh on sentiment, which gets priced into the market. So there's a high risk premium on South African assets. And by buying South African assets, you earn that high risk premium. You earn those high returns because of the pricing of the assets. So you have to disentangle sentiment, which is what Magnus talks about. When he talks to his clients, he needs to comfort them. The best way to comfort a client who has negative sentiments around South Africa is to take the money offshore. It's like buying an insurance policy. You're comfortable in living in your house when a storm comes and the roof blows off because you've got an insurance policy that'll fix it for you. But that insurance policy costs money. Taking your money offshore costs you money. And that money in terms of investment is lower returns than you can get here. It's more comfortable, but it costs you money. And that is the lesson from Dimson, Marsh and Staunton's work. And I think that is a lesson from this little exercise that we've gone through over the past 4.5 years. That's a bigger lesson.
Sure. That's an extraordinary eye-opener, Piet, because when I have a look at your performance, one of my obvious questions was how much of this is due to improved sentiment in South Africa, because things are a little bit better here, and how much is due to earnings and the performance of the underlying companies. And you've really, and thank you, the whole Business tribe thanks you for HCI and Sabvest. And but you've also got Argent and Lewis. Of course, we've got Lewis in our portfolios as well. But how, if you were to determine, if you could, which of those two were the greater drivers?
It's neither sentiment nor earnings. If you are buying a company on a PE of 6, that means an earnings yield of 15 or 16%, 17%. Just by going sideways, that company is earning 15, 16, 17. It doesn't have to grow, and it's earning you 15, 16, 17% on your capital just by going sideways. If it starts growing a little bit, the returns go incrementally higher. So it's very simple. You buy low PE stocks, as long as it isn't a value trap like these retailers in Africa buy the stupid things offshore and destroy value. Companies like Lewis, there's a P of 7, companies like Argent, a P of 4. Those sort of things give you high returns just by being there. They don't have to do anything. It's very simple, very easy. So the returns come from the pricing of the asset. The assets are priced attractively. That's where the returns come from. If we were to grow going forward, say we were to grow in the next couple of years, the returns from these assets will be astronomical. They have been good because they're priced, but all we've got is the pricing. We haven't got any growth, any improvement in sentiment. I think there's still rich pickings here even from current levels.
Please explain what PEs are. There would be many people who are new to investing who might be a bit confused.
PE is simply you take the current earnings of the company and you compare that to the value, the price of the company. So if the price of the company is 10 Rand and it earns 1 Rand per share, the PE is 10 times 1 Rand's earnings. If you invert that, the earnings yield 1 Rand of earnings on the price of 10 Rand, that's a 10% earnings yield. That's what you're earning by investing in a company with a P of 10. You're earning 10% on your capital. If it grows, you earn that 10% plus any growth.
So essentially, if a company is on a price to earnings ratio of 5, just for argument's sake, and there are some on the Johannesburg Stock Exchange priced like that,
it's a lot.
You are getting a 20% return on your investment in that company, in what the company is generating in profits, if it just stands still. Isn't there another issue that could be involved here? Is when international players have a look at a country like South Africa with all of the issues, all of the problems that we've spoken about, high unemployment, low economic growth, etc., they might say, well, I'm holding off because I could do much better going to Thailand or Indonesia. And as a result, the competition is less. And as a result, if you are one of those companies that's being able to generate 20% return for your shareholders, you might be able to continue to do that, and perhaps for longer than otherwise would be the case.
That is so true. I mean, because of the lack of capital in this country, due to advisors taking client money offshore out of this market and offshore investors looking at the market and say, we don't want to invest here, there's very little capital here. So the returns on capital are quite high because there is less competition. And yet there's still companies who want to buy assets offshore in countries where there's a lot of competition, and they get their heads handed to them on a plate every time, every single time. Here, the competition is less, the returns on capital is higher, it is much easier.
I suppose it's like when I used to play football in Newcastle. I thought I was quite a player, and maybe I could even try and be a pro. But Newcastle is a very small town in KZN. Had I been playing in Johannesburg, it would have been a different story. Magnus, from from your perspective, you have to deal with a lot more, though. As I mentioned earlier, you are an advisor. You're dealing with people all the time, and if the sentiment is so negative, must be very difficult to put forward Piet's argument to your clients, even if you wanted to. And I guess we got to find out if would you.
The big issue is the political risk or the interpretation of political risk, and that you cannot ignore in our markets. And I'm well aware of those long-term studies, and it's absolutely true. The JSE was driven by gold, platinum, and diamonds. Alec, when we became journalists in the 60s, the 70s, and the 80s, it was a wonderful place to invest your money. Things have changed since 2010. Up to 2010, that is, the numbers were actually absolutely correct. But if you do a number from 2010, which I've sent you some stuff incidentally, if you take the 15-year period, SA versus the rest of the world, South Africa has not done well. Over 10 years, over 15 years, 7 years, over 5 years, it's done okay. And last year did exceptionally well. But you must remember, if you compare, it also, against which market are you comparing South Africa? Are you comparing it against emerging markets, world markets, S&P 500, or the NASDAQ? Well, let's take the NASDAQ as an example. If you were an aggressive investor and you wanted exposure to the NASDAQ, which has been a phenomenal place to put your money for the last 15 years, despite the volatility, South Africa simply did not offer you any exposure into the NASDAQ, and maybe indirectly through Naspers, and that's very big risk, only one share. The big issue is that the JSE has been shrinking in terms of the number of listings, and everything that Piet says is correct, but it does not answer the question of political risk, which is always prevalent in the markets. And I can only speak for, I look at the statistics. I looked at some statistics last night from the outflow of money from South Africa in total since 2010, when the allowances were increased to 10 million rand per person per year. Since then, legally, through those channels, 1.2 trillion rand has left the country through Reserve Bank approval. So that's why Piet is complaining there's no money invested in our local market. Investors, large and small, have decided they are safer with their money offshore. So that's a massive amount of money that has left the country. Last year alone was 160 billion rand that left the country through these channels. And every big institution in South Africa, whether it's Discovery Bank or Standard Bank or Old Mutual, have offshore channels. They've created offshore channels or offshore partnerships. And lastly, that is what the clients prefer. They want their money offshore against political risk or perceived political risk. So that's the first point. So the political sentiment amongst retail investors is extremely negative. And I probably would not have had a business like we have today if I kept on saying, stay in the SA market, stay in the USA. It's simply not what the clients want. They wanted their money offshore. They felt better. And a point I made in the article that you can still invest in the South African market from your offshore portfolio. You can simply buy a cheap iShares South African index from London or from Guernsey or anywhere in the world. So you're not excluding South Africa But retail investors have moved their money offshore, and I know the fund managers don't like it. They see it in their flows or the lack thereof. But I have to listen to what my clients want and what they prefer. It's like telling somebody in South Africa, hey, you must fly with SAA. It's our national airline, and you got to support the guys. The clients are saying, no, I'm flying Virgin, I'm flying Lufthansa, I'm flying anything else which gives you better service and better pricing, if I may use that analogy. So the overwhelming evidence, and I often say to people, I said to a friend of mine the other day, you must just come and sit and listen to what clients are telling me, what they want, what they fear about South Africa. And if you try and convince them otherwise, they will take their stuff and go somewhere else because they want their money offshore. It's not the asset, it's the location of their investment, which is more important than the returns that they are getting on the local market. They just feel more comfortable. Maybe they've got long term immigration plans, their kids might be immigrating. And having your money locked up in one country doesn't make any long term commercial sense from a advisory perspective. And one final point, we've seen how Treasury can change the rules of investing. The rules where they want to put a threshold on your cryptocurrency investment, gold and currency, was an absolute shocker to the investment community. And there people are saying, look at what Treasury can do. They can change the rules overnight. We're not comfortable with that. And it's a political issue rather than an investment issue. That's why people are taking their money out of the country. They simply don't trust the ANC to create an environment to protect their assets long term. That's why they want it offshore.
Piet?
Look, I agree with Magnus. I agree the sentiment is super negative. I agree the money is flowing out. That the numbers show that. But that is the reason why the assets are cheap and why the returns are high. So, and I think it's a bit of a chicken and egg situation. It's very lucrative to move clients' money offshore. It's a good business to be in. So there are numerous advisors. It's in their financial interest to spread, these stories about how bad things are and how terrible things are and how negative. I mean, it plays to the market. The market wants to hear that stuff. Sentiment is negative. You play to the market. You give the clients what they want, apparently, and you make a lot of money that way. And that's fine. That's a business. That's how it works. I also agree with Magnus that you can't have all your eggs in one basket. It would be stupid to have all your money in South Africa. I mean, you would. That's not good risk management. But you have to realize the money you take offshore is your insurance policy, as Magnus points out. It's an insurance policy against political blundering. But like any insurance policy, you pay a price for that. And insurance policies are normally grudge purchases. But the way the advisor industry has painted the situation out to their benefit is that it's actually to your benefit to take the money offshore, and it isn't. The numbers prove that you earn poor returns. Yes, you can pick out certain markets where it's been better, other markets have been worse. On average, the South African market does better than the average market in the world. That is on average. So if you're a brilliant asset allocator, you can pick that market over that market. Maybe you'll do better. I don't know. Maybe some people can do that. Some advisors maybe can do that. I can't. All I can say is, on average, the returns in Africa are better than the returns offshore. Moving the money offshore gives you comfort. You pay a price for that comfort. That is the message. But yes, have money offshore. It is an insurance policy. And I have money offshore. All my eggs aren't in this basket. But a lot of my eggs are here because this is where the returns are. This is where I understand the market. This is where the business community understands the market. Your networks are here. You can make money here.
Magnus?
Yes, Pete's absolutely correct. But remember, when we talk about offshore investing, we're only talking about discretionary money and money that is under your discretion. Remember, there's still a lot of money being managed by companies like Brenthurst that has to remain in South Africa in various Reg 28 funds, living annuities, provident funds. And there we make use of local funds by all means. We use peace funds, we use 361's funds. We use all the local funds because we can't take the money offshore and we don't want to. And the returns have been excellent. I just think that, to blame advisors are in fact, local advisors were initially very reluctant to take money offshore. When I started recommending this on radio programs and columns, I got flack from my colleagues. I was slandered and don't know what you're talking about. But if you look at the returns of especially things that we don't have in South Africa, we do not have a technology a sector where you can invest in technology funds. The technology funds that we've been using for 15 years now have created enormous wealth for our clients as a diversification and participating in a massive bull market, which is undeniable. I mean, the last 15 years, if you look at anything related to the internet, technology, and now recently AI, the returns have been stupendous. They have been 30-40% year after year, and depending on the allocation in a portfolio, you could not get those returns in South Africa. You had to take your money offshore and put it in a fund there in Guernsey via the various platforms or ETFs for that matter. So there are many nuances to this debate. It's not only risk return and how much did you make. There are many issues attached to that. If I might just add, I've looked at the report on the outflow of money. They asked people, why are you taking money offshore? Well, diversification was number one. The second one was to fund their kids' education. Third was to buy property offshore, and fourthly, potential immigration. So it's not only getting everything offshore. There are good reasons why people said, I need to get some money offshore when the rand is strong, because the rand could weaken suddenly. I do need to have an offshore nest egg because I might use it in future. My kids might use it.
Piet, jy lag lekker.
Offshore property. There's only one thing worse than buying local property is buying offshore property.
Oh my goodness! But what about the? Let's close off with from both of you, just in a minute. Intellectually, when you look back at where we started in November 2021, when you had the 500,000, you would have had certain visions of what would happen to it. And when you look at it today, from your side, Magnus, it's 689, from 500 to 689. You've shared with us a little bit about what went wrong, but how do you kind of look at that and say, okay, I've learned all of these things. If I were to start another competition in 6 months' time when this one ends, how would I do things differently, and how can I pass on that wisdom? Just in about a minute.
I was going to demand a rematch.
You may get it.
But, there are two issues there. I played around with my computer last night and I looked at the returns of the major global indices since that date. I think it's the 11th of November 2021. If I had simply ticked 30% NASDAQ, 70% S&P 500, I mean, I would have been way, way ahead of its fund. It's not the case of offshore local. Offshore did beat everything over that period of time. If you just bought a couple of index funds, if it's a competition between me and Piet, he's by far the winner. He is a much better fund manager, and I think the question one learned is offshore did beat. My view is still the same. I don't necessarily agree 100% with Piet about how cheap the local market is. I think the local market is cheap for a good reason. It's cheap for a very, very good reason. Now, and it's not only Piet. I listen to a lot of value fund managers who talk about, if there's an uplift in economic growth, the profits will come through. I slightly disagree on that. I think local companies have done all they can to remain profitable. They've cut costs, they've cut staff, they've downsized. There's only so much you can do to unlock value in a company. You need economic growth of 2 to 3% or higher to unlock the value in these companies. So I suspect that these big value discounts in the South African companies, I'm talking about SA Incorporated, are going to remain there for a long time until the economic growth kicks in. And if the growth picks up from 1 to 2%, then Piet is 100% correct. All you need is a bit of growth, and our companies will make super profits because they've all slimmed down, they've trimmed down, they've taken They've taken their balance sheets are looking good, but you need growth, and the growth is in the hands of the government, and they're not delivering on that promise.
Okay, nice long minute. Perhaps you can stick to yours, Piet. What's the last word?
Very simply, the value fund has performed in line with my expectations. It's outperformed the MSCI world, the average stock market in the world. You can cherry pick NASDAQ and S&P 500. That's one country. The US is not the be-all and end-all. It might not be the same in future. Who knows? Value fund has outperformed MSCI world in line with our expectations. You don't need growth for good returns here. These stocks are priced on earnings yields of 15 to 20%. Things can go sideways as they have over the past 5 years, and you still make good money. But you do need offshore diversification. It's important to have that, but realize you're paying a price for it.
I like that. I like the way that both of you have framed the competition in the one hand, and also what you've learned from it, and basically where you should be looking ahead. Because I think members of the Business News Tribe will certainly take a lot out of this. I'm also delighted that both of you will be in the Drakensberg for our BNC 9. We were going to have it as an investment conference. Now we're having it for everybody. And 26 speakers, Piet and Magnus, will be have starring roles in that event. And once again, they'll be giving us the benefit of their wisdom. Piet, for the, every single conference we've had so far, he's been there. And I think listening to him today, it reminded me why. So thank you, Mr. Viljoen. Thank you, Mr. Heystek. It's been lots of fun. We've got 6 months to go. Anything can happen in this volatile world that we're in. But I guess right now the odds are very much in Piet Viljoen's favor. And I think that the lessons that all of us learn is that get a plan, stick to it, be careful to be buffeted by the winds. And that's what the Obas used to say, Warren Buffett would say, is when you make a decision in investing, have an average holding time of forever. Now, of course, that doesn't always work out, but at least if you know what it is that you're following, and Piet's logic is clear, it's obvious. He's getting 15, 16, 18% returns from solid companies that are going to keep delivering that come hell or high water. And Magnus's view is, I'm worried about the South African political issues. I need to have money offshore. I guess the question here is how much you put in each side. And that is a question that we are going to ensure they give us a full-on answer to when the competition ends. We might also be asking them for a rematch. Would you, Piet? Would you give Magnus a rematch?
Given current valuations, all day long.
All day long. There we go.
I think the rematch is in our contract.
Magnus and Piet, as always.
All I would make is Magnus isn't allowed to invest into the value fund from offshore.
which I do, believe it or not. I do. Anyway, guys, thank you so much. Thanks, Piet. Cheers, guys.
Always good to be talking to the two of you. Magnus Heystek is the founder of Brenthurst Wealth. Piet Viljoen is the founder of ReCM and manages the Merchant West Value Fund. And I'm Alec Hogg from BizNews.com.